Yeah, good afternoon, everyone. You are most welcome to our today's class. Today we are looking at I-16 property and plant and equipment. Last time um, we ended by looking at consolidating income statement, and that was actual the second last bit of our group accounts. The last bit was media acquisitions, but it is a small thing which I believe if you go and just look at it, it is not a big problem. But now that we've finished the major issues in groups, I want us to today look at a different thing, that is I-16. So I-16, that is property, plant, and equipment. And property, plant, and equipment, basically, um, in this standard, we are going to look at uh, the objective. We shall look at the objective of I-16. We look at the scope of I-16. We look at the major definitions in I-16. We look at the recognition criteria and measurement basis. So let's first look at the objective. What is the objective of this standard? The objective of I-16 is to prescribe the accounting treatment for property, plant, and equipment such that users of financial statements can have information about an entity's investment in its property, plant, and equipment, and the changes in such investment. So that is the major objective, to guide the accounting for property, plant, and equipment, yeah, so that users of financial statement can have information on an entity's investment in property and plant and equipment, and they make their own decisions. Two, let's look at this bullet that the principal issues in accounting for property, plant, and equipment are basically three. One, recognition of the assets. Two, determination of the carrying amounts of those assets, and the depreciation charges and impairment losses in relation to those very assets. So we are going to look at these issues. Before we look at those issues, let's look at the scope. What is the scope of I-16? I-16 does not apply to the following items. One, property, plant, and equipment classified as held for sale in accordance with IFRS 5. So where you are looking at property, plant, and equipment or tangible assets which are held for sale and maybe for discontinued operations, then you are not guided by I-16, you are guided by IFRS 5. Biological assets are related to agricultural activity. When you are dealing with agricultural assets, then you are not guided by I-16, rather you are guided by IS-41 agriculture. The recognition and measurement of exploration and evaluation of assets. So where you are dealing with assets that arise as a result of exploration and evaluation of minerals, then you are guided by IFRS 6, but not I-16. Let's look at the major let's look at some of the key definitions in the standard. One, property, plant, and equipment. What is property, plant, and equipment? Property, plant, and equipment is defined by the standard as the tangible assets which are held by an enterprise, yeah, for use in production, supply of goods and services, or for rental to others, or for administrative purposes, and are expected to be used during more than one accounting period. So when you are looking at those tangible assets which are held by an enterprise, to do the following functions. One, either to produce or supply goods and services, or they are used for rental to others or for administrative purposes, and they are to be used for more than one accounting period. Then you are talking about property, plant, and what? And equipment. Mhm. Yeah, for production of goods and services, like in manufacturing, yeah, when you are using the premises to manufacture, then uh, they are part of property, plant, and equipment. When you are using um, like buildings and you are renting them to others. Yeah, you are renting them to others. For others to generate income, for you just rent. We are saying for rental to others. Yeah? That means you are renting them. I mean you have a building. I beg your pardon. I beg your pardon. Let's not confuse it with investment property. Now, when we say for rental to others, it means you pay rent to another person. Some other person has a building, he rents it to you, you pay him rent. Okay? That is for rental to others. So in your assets, yeah, when you use someone's building for your own business, then you report that very building, yeah, in your balance sheet. But if you have a building and you are renting it out, you get rentals from the building, then it means for you now you are using the building for investment. So it is an investment property. It is accounted for under IS 40. We shall look at IS 40. For administrative purposes, that is when you have a building and you have some rooms, you're using them as office. So that is how we can find property, plant, and equipment. Depreciation. Depreciation, that is the allocation of the depreciable amount of an asset over its useful life. Fair value, maybe fair value. What is fair value? Fair value is the price that you would receive from selling an asset or an amount you would pay to transfer a liability between market participants in at the measurement date. So that is fair value, the price you will receive from selling an asset. Yeah, or something or an amount of money you would pay to transfer a liability in another transaction between market participants at the measurement date. What is an impairment loss? An impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. So we have two concepts: carrying amount, which is cost less accumulated depreciation. Then you have recoverable amount of an asset. We are going to look at the recoverable amount of an asset. But where you have the carrying amount of an asset exceeding the recoverable amount of an asset, then it means the asset is suffering, yeah, from impairment. So that asset must be impaired, and the impairment loss must be taken to profit and loss as an operating expense. Recovery amount is the higher of an asset's fair value less cost to sell. Yeah. Recovery amount is the higher of an asset's fair value less cost to sell and its value in use. Yeah. So just a minute, then okay. So let's proceed. And we are actually looking at those key definitions, and we had reached at impairment loss, then recoverable amount. These two concepts you will actually cover them when you are dealing with IS 36. Recognition. When should we recognize an item of property, plant, and equipment in the entity's accounts? An item of property, plant, and equipment should be recognized as an asset when two conditions happen. One, when it is probable that future economic benefits associated with the asset will flow to the entity. Two, when the cost of the asset can be measured reliably. So these two conditions, if they prevail, then it means you should be in position to report the very item of property, plant, and equipment in the balance sheet. Control, the entity must have control of an asset. This one is in accordance with the definition of an asset. An asset is defined as a resource controlled by an enterprise from which economic benefits are expected for the enterprise. So control, of course, will come uh, uh, from the fact that when you are an entity and you have uh, ability to restrict others from using your asset, then it means you are in control. Then that one will define that fair item to be the asset. Yeah, that is control. So you can go and look at your definitions of asset. Then you next measurement. Let's look at measurement of an asset. When do we measure an asset, or when we measure an item of property, plant, and equipment according to I-16? An item of property, plant, and equipment should initially be measured at cost. Yes, cost meaning the purchase price and all other costs that are necessary that you actually incurred and bring the asset into its working condition. They could be import duties, direct attributable costs like cost of site preparation, installation, professional fees, etc. So you are looking at the purchase price plus any other cost you incurred before you bring the asset to its present location or before you bring the asset into its working condition. You may have such costs like revenue costs. Revenue costs are not supposed to be capitalized or added to the purchase. These ones they should be written off as having been incurred and to profit and loss. So any revenue cost should be written off as operating expenses, for example, administration, startup costs, yeah, and any initial operating losses. These ones should be written off to profit and loss. If the enter constructed an item of property, plant, and equipment rather than buying it, then it might incur other other costs. Yeah, that is according to IS2, which may also be included, and these are material costs, labor costs, architect fees, and direct overheads. So here we are saying if instead of you purchasing the item of property, plant, and equipment, now you make it, you manufacture it. Yeah. Now the cost will be the production cost or the cost of manufacturing. And you know the cost of manufacturing. Cost of manufacturing normally comprise of the materials, labor, and other overheads, especially those direct overheads or those overheads which can easily trace during what? Production. So that is when you are looking at the cost of what? Manufacturing. But if you are looking at buying, then the cost of the property, plant, and equipment will be the purchase plus any other costs you have incurred before you bring the asset into its what? Operation. Um, we are still looking at initial measurement, but we just need a break of 1 minute. Then we come back, we proceed. 1 minute, a break of 1 minute to come back, then we proceed.